Hey everyone, Ryan Bolton here, local mortgage expert with Patriot Home Mortgage. I'm in southern Utah. I do lending in Utah and Nevada. And I like to jump on here once in a while and just answer questions that I found on the internet. Some have been posted to my Facebook page, some to the YouTube channel here. So if you have any questions, comments, concerns, please put them in the comments in the video below and I will get to those in a future video. So let's just jump into this. I like to try to do about 20 minutes or so. So let's see how many we can answer in that time frame. So here's a list of questions that I've got. Let me get to the right one here. Okay, first one. What happens if you pay off a reverse mortgage? I always ask people, what do you think would happen? Because I want to get kind of a framework of what they think would happen. Whether it's a forward mortgage, like a standard conventional FHA, VA, whatever type of forward mortgage it is, or a reverse, the same thing happens. Once you pay off the balance of the loan, there is no more loan against the property. Now, with the reverse mortgage, there's no payment. So on a normal mortgage, the payment would also go away because you paid off the loan. But with a reverse mortgage, then the property just becomes free and clear. The most common way to pay off a reverse mortgage, though, is when you sell the property. I don't see a lot of times where people just take money out of their savings or investments to just pay off the reverse mortgage. But that is the same as if you paid off any mortgage. It would just free up that property. You wouldn't have a loan against the property anymore. Let's see. How long are mortgage rate buy downs good for? So typically, that's when you hear the numbers with a buy down, you usually hear 2-1 buy down. This is talking about the cost to get it and how far the interest rate has dropped. What essentially is happening on a 2-1 buy down is the rate is still the rate, you're just prepaying the interest. So the rate is cheaper for the first couple of years. So there's 1-1 buy down, 2-1, 3-2-1s. I mean, there's a couple out there. I'd say the most common is a 2-1 buy down, but essentially you still have the same rate. You're just prepaying the interest to have a lower payment for the first 12 months or 24 months, depending on how it's structured. Now, that interest can be paid by you upfront or building it into a little higher rate when it's over. Or what I'm seeing a lot is the builder or the seller is willing to pay some closing costs. You can funnel that credit towards doing a buy down on your loan. So I'm kind of on the fence on buy downs because it's something where you're usually getting a higher rate than the rate that's available today because you're kind of building in some of that rate. And it's something where I think you're going to see rates have more pressure to move down over the next 3 years. So you end up kind of refinancing anyway. You kind of paid extra money for a loan you're not going to have for a long period of time. But it's important to sit down with your situation. Maybe your income's going to change. Maybe finishing school or you have a spouse where you just need kind of a temporary lower payment for the first 12 months because you know you're going to be able to make up the difference. So it's not really an adjustable rate mortgage. It's just you're prepaying the interest on the loan for that introductory year or two, depending on how it's structured. All right, let's see. What alternatives are there to having a mortgage to buying a house? So a mortgage is really the loan to get the house. So you can get other loans, maybe tied to other properties. You can pay cash, but if you don't have the money to just pay cash for the home or don't have other equity on another property or other assets to pay cash for it, you're going to get a mortgage. That's just the name of that loan. So it's not like all of a sudden you can get a car loan for a house or, I mean, I guess you could if you have enough equity on the car. I mean, but that's really the term of what that loan is. I know a lot of people are just scared of the word mortgage or application. I can't tell how many clients will reach out and as soon as you say, okay, fill out the application, they just go, whoa, I'm not ready for that kind of commitment. And I get it. It's intimidating. You don't want to fill it out wrong. Maybe you're not quite ready to do an actual application, but it's amazing how much that'll help us get you better answers. It doesn't lock you in or force you to do a loan. If anything, it helps us to get you a better loan by doing the application sooner. I cannot tell you how many times people will call me up and their lease expires within 30 days, 40 days, and they only have that window to work something out. Where if we would have had 60 days or 90 days to work on a few things, they would have got a better loan. They would have been able to get approved for different loan programs, or maybe we could tweak the credit a little bit, pay down some cards or just adjust their situation a little bit to help them get a better loan. But we're just out of time. So I don't know if it's a microwave society. I don't know if it's just now. I finally want to buy a house, so now I want to do it. And they just put it off. But don't put off doing your pre-approval. Don't put off doing your loan application, because this will allow us to get you more ready. You can shorten your time frames when you make your offer. You can get your ducks in a row with paperwork. Sometimes it takes a little effort to get a pay stub or a W-2 from 2 years ago, or your tax returns, you have no idea where they are, or you switch CPA firms. I mean, having that list to kind of work on and have a little time to work on it is way better than saying, okay, you got 30 days to get approved, find a house, move, pack. That's so much stress that you don't have to go through. Oh, I got something in my eye. Hold on a second. I'm going to pause. Okay, on to the next question. If you pay a mortgage, is the house considered yours? I've mentioned this on a couple other videos, and it is a common theme out there. I hear it all the time, whether it's a car loan or a mortgage loan, that when you have a loan, you're really just renting it from the bank. This couldn't be further from the truth. And here's why I say that. When you have a mortgage, it's the collateral for the loan, but the mortgage company does not own your home. They can't just show up and say, hey, we own this house. We're going to rent it out to some friends. We want to paint the kitchen, and we really don't like the tile in this room. We're just going to tear it out and do new tile because it can sell better if we have to foreclose. So we're just going to come in and do stuff to your home. That would be crazy. They don't own the house. They don't own the property taxes or pay the utility bills or own the homeowner's insurance. It's simply collateral on the loan. If you don't make your payment, then they can take back your house. But even then, there's a process to do that. It's not like you miss your payment and all of a sudden the house is back to the mortgage company. There's a process, there's a waiting period, there's reinstatement options. You have to go through this entire foreclosure process before the bank can really even get the property back. Then they have to try to sell it to recoup their investment. So this idea that if you have a car loan or a mortgage loan that you're just renting from the bank couldn't be further from the truth. It's just the collateral on the loan. If you don't make your payment, they can take something back. That's why rates and terms are better on mortgages than, say, revolving lines of credit that are tied to nothing, or even car loans sometimes, because there's something you can't just run off with. There's a fixed asset. There's something that the investors, the lenders, the whoever's involved in backing the mortgage can take that property back. So it's collateral. They don't own it. They don't own your car. They don't own your house. It's simply the collateral. All right, let's go on to the next couple questions here. And time-wise, where's my little clock? Oh, yeah, we got plenty of time. All right. Let's see. Can someone refinance their home without telling the other party involved in the original mortgage? No, if they're on the ownership of the home. So there's title companies that essentially handle the transaction for when you buy the home to get the home in your name. If you sign an original loan, you have maybe a spouse or a co-borrower or a brother, something that co-signed on the loan, they're equal owners of that property. So the one party, say we have a husband and a spouse, the husband can't go refinance the home or even sell the home without all parties acknowledging what's going on, as long as you're actually on the title of the home. Now, I've seen times where the spouse can't qualify, or there's a reason not to have one of the spouses on the actual loan, so they don't get put on the title report. In Utah, there's what's called a warranty deed. This is what adds, maybe you move it into an LLC, or you move it into a trust, or you add a spouse. That's the form that you record with the county to make sure that all the owners are of record. So if you're not of record, then you wouldn't have any ability to stop somebody from selling the home because you're technically not an owner. But if you sign on the loan, if you're on the mortgage to buy or this original mortgage, I can't imagine why you wouldn't also be on the property, because the lender would require it. If you're on the loan, they want you to be tied to the property. So you'd be a buyer or a refinancer or something that's on the property. So what I see happens with these situations a lot is that there is some sort of co-sign situation, or usually a spouse, maybe they're going through a divorce and they're worried, okay, can my husband just go and sell the house or refinance or pull the money out? The answer would be no, unless you're not on the title. You can go to a title company in your area. They can pull it for you. You can go to the county records and you can see kind of, okay, who's the owner of this house? What is it listed? If you're not on it, then the owner would have to add you to it. So your spouse or family member, whoever it is, would have to add you to it. Now, if it's moved into an LLC or a trust, you have to be listed on those trust documents or the LLC to also be an owner that way. So there can be a little bit of moving parts with it. But the shortest answer to this question is no. Can someone refinance their home without telling the other party involved in the original mortgage? No. They'd have to disclose and get them to sign off on any new loans that would be put against the property, whether that's a first mortgage refi or adding a second mortgage or anything that encumbers or puts a lien on that property. All parties would have to sign off on it. All right, let's see what we got here. What will happen if I'm not paying my home loan? So if you don't pay the loan, we kind of talked about this a little bit about renting collateral and stuff like that. But if you don't make your payment, once you're 30 days past due or 31, so your calendar day past due, the lender would send out what's called a notice of default. This is a public notice that goes out that says, okay, this home is now default of its loan terms. You have 90 days to reinstate the loan by catching it up, selling the property, talking with the lender, figuring out a modification or whatever you can do to kind of get the loan back into good standing. After that 90-day waiting period, that's when they can put the home on the auction block and advertise it out to investors. They do a public notice at the courtyard steps and says, okay, 123 Main Street is now available to sell. Here's the sale date, which is usually about 30 days after that 90 days. So you can start that process while the 90 days are going to kind of get that on the clock. But generally, you're going to see lenders wait the 90 days, then put it out on the auction block. Now, what you'll also see is sometimes you'll have modifications. They'll work it out. They don't have to do it right at the 30 days. I've seen lenders go 30, 60, 90, even 120 days before they start the notice of default. So it just depends on the situation, depends on how many other foreclosures they have in the area, depends on who's servicing the loan when they start that process. But they cannot do anything to remove you from the home without starting that 90-day waiting period, the notice of default, what we call NOD. So once the NOD has been filed, the 90 days starts and you're on the clock. Even if the modification department says, hey, we're working with you, maybe we can lower your payment for a year, put the interest on the back end, maybe you lost your job or lost a spouse. I mean, there's all kinds of reasons why homes go into foreclosure. So sometimes a lender will work with you, but they don't want to wait on that 90 days. They're not just going to restart that every time you turn in a modification application. So I've talked to a lot of people that are on the NOD list and they say, oh, we're working with the lender, we'll be fine. Just know that 90-day clock is ticking. And a lot of times the department that handles the foreclosure is going to be different than the department that handles, say, a modification or a refinance or restructuring your loan to kind of help you stay in the home. So just be aware of that. I've seen a lot of people go, well, hey, I thought I was working with a modification company. And now all of a sudden they've got an auction date and I got investors showing up and people walking around the house and stuff like that. Just realize they really are two separate departments and they don't want to restart the waiting periods and they just get the waiting periods out of the way, then decide when they're going to actually put it on the market. So if you're running into a foreclosure situation, you can give me a call. I can walk you through a couple different options with your lender. There's also options where we have investors that will help you purchase the home. Maybe you had a parent or something that passed away. Maybe you've got a situation where your husband's passed away. I mean, horrible situations that lead to foreclosure. You lost your job and you just want to get out of the home, maybe cash out your equity, move on, lick your wounds and move on. We have investors that will help you with that. So if you're going through a foreclosure that's imminent, let's talk. I'd love to at least show you some options and see if we can help you there, especially in Utah and Nevada. That's where I do my lending is Utah and Nevada. Let's see how we do on time. I try to keep these about 20 minutes. Looks like we're about 13 or so. So let's keep going. So the short answer, what will happen if I don't pay my home loan? Eventually you lose the house. That's the collateral. Eventually you'll lose the house. There is lots of steps before that, but that'll end up down the road if just nothing else happens. Let's see. Let's see. How do you create a payoff mortgage letter? So this might be if you're going through a refinance or you're selling a house, the payoff letter is a letter that the lender will give you that says, okay, on this date or up to this date, this is how much it takes to pay off the loan. Keep in mind when you're refinancing or selling a home, when you make your payment, so say for the month of November, you're actually covering the interest of October. So when you see your principal balance on your statement, that's not what it would take to actually pay off the loan because interest has accrued since that particular day. So if you pay your payment in November, you've covered the October interest. Then if you're 10 days into the month, you've got those extra days of interest you have to cover on your payoff. What I see happens a lot of times is somebody will sell their house. It's going to close on, say, November 10th. So they don't make their November payment because they're kind of within their grace period or the entire loan's going to get paid off. And all of a sudden they're like, whoa, the payoff was way more than my balance because they have to cover October's interest plus whatever days of November to actually clear off that loan. Another quick mention I should do here as well. When you pay off the loan, if you have an escrow account for your taxes and insurance, that will be refunded within 30 days after the loan is paid off. After they get the wire, close out the account, they have 30 days to get that money back. It doesn't automatically come off your payoff. I've seen some lenders where they give you that option, but generally speaking, they're kind of separate accounts. So they don't want to commingle what's in your trust account for your escrow for taxes, insurance, and the principal balance on the loan. So what you'll see typically is they'll refund whatever's been accumulating in your escrow account about 30 days, within 30 days of when you close or refinance or pay off that loan. So keep that in mind. You want to look for a check. If you don't get one, you definitely want to call your lender. If you don't have an escrow account, this wouldn't apply. So it's only if you have a escrow account for taxes and insurance. Let's see. Okay. Where can I find pre-qualified mortgage rates from multiple lenders? That's just part of shopping around. And I will tell you this. A lot of people are very concerned with shopping lenders, and we all get the money from the same sources. We all follow the same guidelines. You're not going to see a huge difference between lenders. You're really not. But that's part of my job, is to know what other lenders are offering. So really shop the person you're working with and see how many lenders are you working with, how many lenders are you working with on a daily basis, like how many rate sheets you get and all that kind of stuff. Because we're all following everybody. We see everybody's rate sheets every single morning. You're not going to see a huge difference in interest rates. Now, fees might differ a little bit, depending on one company might charge a little more for processing and underwriting, or maybe they roll those into one fee or they itemize them out to certain fees. So every lender is going to be a little different there. That's really what separates mortgage companies, not so much the interest rate. But it is something where it's worth calling around and checking with how many sources they're going to check on, and just see who really returns their phone calls, returns the emails. That's really what's going to separate you with mortgage lenders, is just service. That really is going to be the difference. All right, let's see. Can a home loan be taken on an already built home? Of course. Can a home loan be taken on an already built home? In fact, that's really what the home loan is. If it's not built, it's really a construction loan, which is a different type of mortgage loan. They're all kind of fall under the umbrella of mortgage because they're tied to real estate, they're tied to a property. But if you get a construction loan, it's more of a short-term loan, just for the course of construction. Then it rolls into a permanent loan once it's done. So that's really what a mortgage and a home loan is a loan on a home that is already done. If it's not already done, then it's a construction loan. All right, let's see. What happens if I leave my house without paying my mortgage? Eventually, the mortgage company takes back the collateral. So they'll take the home. Your credit will show late. You'll really mess up your credit report because it'll go 30, 60, 90, 120 days late. You'll have a harder time getting a mortgage in the future, at least for a certain number of years. So it's not best just to walk away. It really isn't. Call your lender. If you know you've lost your job or death in the family or just something's caused it to where you can't make the mortgage payment anymore, reach out to the lender. They will usually have some sort of option, or you can do a deed in lieu of foreclosure where you can give it back to them without having to go through major lates and that kind of thing. But generally, most people have equity in their home. If you really had to sell the house, you might have some money left over. So just walking is really the worst option, and it will have more ramifications down the road than it's worth, versus just making a couple phone calls and owning up to it and say, you know what, I overextended, my job changed, I had this bonus structure or way more hours, they cut my hours, whatever it is, or my spouse worked, now she doesn't, or he doesn't, or there's always kind of situations that do that. But foreclosure right now are just record low because most people don't have to just give the home back to the bank. They can sell it. They can sell it to an investor. They can maybe rent it out and cover the payment. If it's really a payment thing, try renting it out or something. So there's usually other options than just walking completely away. But call your lender. That's the first call I would make and say, you know what? I know I'm going to have problems making my payment in the next couple months. My income's gone down, expenses have gone up, medical, whatever it is. Talk with your lender. They usually will have some solutions besides just putting your hands up, walking away, and just hoping it goes away, because it's going to damage the credit and your ability to buy a house for years and years and years. All right, let's see if we can squeeze in one more. I try to keep these about 20 minutes or so, unless there's just something really cool and I get on a soapbox, which I am known to do occasionally. So let's see. Oh, okay. So this is kind of along the same vein of this idea of whether you rent your house from the mortgage company or you own it. So another question, why does a bank buy back its property in a foreclosure sale? Because they don't own it. So what happens is they foreclose on the property, they do the notices, they set the courtyard steps, and they set the sales price or the offer, the first bid, at what they're owed. So let's say it's 300,000. Let's say they're owed 300,000. They bid for 300,000. If nobody outbids them, so nobody shows up and bids 301, 305, 310, doesn't bid anything more than that, then the bank wins the bid, they win the property. So they become the owner at that point. Up to that point, they don't own it. They're a lien against the property. It is the collateral on the loan, but they don't own it. So that's the process of foreclosure, is to give the notice to the buyer or to the owner. If they're not able to reinstate the loan, sell it, whatever, they then go to the courtyard steps. And what typically happens is other investors will be notified, and they'll look at it and say, oh, that house is worth, maybe it needs some repairs, maybe it needs some stuff, but man, that thing's worth 400. I'll bid more. So there's actually a bidding process. They'll be right on the courtyard steps in most counties. Sometimes they do it online now. There's some places that'll do it that way, but most of the time it literally is right on the courtyard steps. They'll sit there and say, okay, this property, 123 Main Street, we're starting the bid at 300,000. Then somebody says 305. And going once, going twice, sold. That person gets the home at 305. The lender gets paid off. Anything left over goes to the owner of the home. So the person that got foreclosed on. So let's say that same scenario. Let's say it gets bidded up to 350 and the first is only 300,000. The difference after attorney fees and whatever else would go to the owner. That's who would get the whole the income that's, or the auction above the price. So most of the time, the bank is hoping they don't become the winning bid on the property because they don't want to own the property. They want to repair it. They don't want to do those things. So typically, they're hoping somebody else shows up at the auction and bids more than that, which we are seeing right now. You don't see a lot of homes hitting the auction because either they can sell it for more than what's owed, or they can work out something with the lender and just stay in the property. So whether that's going to increase, I don't know. I don't think it will, because if you look at the people that own a home right now, they have a debt servicing payment of 3 or 4% on their rate. They have equity in the home. They're just better off staying in the house, figuring out a way to stay in the house than just letting it go to the bank. So I don't think we're going to see this big wave of foreclosures, which won't lead to this big crash because it's not going to add a bunch of this inventory like we had in 08. I mean, there were so many homes just added to inventory that it just was way more supply than demand, and that's why home prices went down. That's why you're not seeing home prices go down this year that much, because it's actually still an inventory problem. Yeah, there's less buyers, but there's also almost less inventory than the less buyers because interest rates have gone up. So that's why the bank has to go through this foreclosure process to end up being the owner, or hopefully somebody just outbids them and they're paid off and they just move on. So I hope that was helpful. Try to keep these to about 20 minutes. If you have any questions, comments, or concerns about the things I talked about today, or if you have any questions you want me to ask and answer in the next video, I'd be happy to do that for you. I really like what I do for a living. I really love the opportunity to work with you on buying or refinancing a home in the states of Utah and Nevada. Now, if you're not in those states watching this video, I have a lot of different people I've met over the years. I can help you in just about every state out there, but those are the two that I focus on. If you have any questions, comments, concerns, let me know. Otherwise, check out my website, and we'll see you on the next video. Thanks again.